Now we are going to talk about gold and how is gold uh, a hedge against inflation. For this, we have with us Harshvardhan Roongta, CFP Roongta Securities. Harsh, welcome to the show. Before we give investment options or explain which is the right investment option in gold right now in the current scenario, let's talk about gold being a hedge against inflation. We all know when the equities are volatile, people move towards gold, which is said to be a safer haven when it comes to your long-term investments or when it comes to volatility of the market. But currently, as we are seeing, the dollar index is getting stronger. Gold is rising, but it's not rising as compared to what it has earlier when there have been volatile times. How do you see gold in the current scenario a hedge against inflation?
Well, Kavita, if we are supposed to understand gold as a product and what kind of returns gold generates, okay, so you have to understand there are two elements. One, gold is a dollar asset, dollar denominated asset. So the pricing of gold essentially comes from what it is quoting in dollar terms. So currently, if you say it would be about 1840, 50 US dollars for per ounce. Now, if you're looking at it in Indian rupee terms, then there are two impacts. One is, of course, the conversion rate of dollar, and the other part is how dollar appreciates over a period of time. Now, if I may give you one long-term data, and just to understand what has been the return gold as an asset class has given. So, if I take data going back to say 1975, okay, that's like about a 47 years, from now, and if you're looking at the return gold has generated over that period of time, in rupee terms, gold has generated a return of about 10.1%. So that has been the CAGR return over last 47 years. The same gold in dollar terms, if you were to look at it, has given a return of about 5%. So in dollar terms, gold is generating a return of 5% over 47 years, 1975 to 2022. And in rupee terms, it's 10.1%. So where is the difference? Where is that 5 percentage points difference per annum? So that's nothing but dollar appreciating over a period of time. So coming back to the question, how gold is a hedge against inflation and whether it forms a part of any investor's portfolio. Yes, if you look at gold, you would naturally have an exposure of about 10% of your total investable corpus into gold. But that's an ideal allocation that you should have because you'll have equity, you'll have debt, and then you'll have precious metals. In precious metals, gold is the most tracked and easily understandable product from a retail investor point of view. So the long-term returns that we're looking at, I've already narrated to you. If you're looking at near term, I mean, if you're looking at last 1 year returns, I mean, gold has given about 6.8% kind of returns. If you're looking at about 3 years and 5 years, it's been double figures. So it's been 10% for a 5 year period and about 14, 15% in terms of a 3 year return. So yes, gold is looked at as a hedge against inflation. The long-term returns depend upon dollar appreciation and the dollar price, the dollar index going up and the gold prices going up. It looks like a decent hedge against inflation.
But do you think in the current scenario one should be putting money in gold or we should really wait for prices to cool off?
It's very difficult to estimate, how do you look at and what do you predict the gold prices to be? So, they have corrected about 2 percentage points in the last week after the Fed hiked the interest rate. So, I would say that you can most certainly start looking at allocating gold. I mean, I don't think you would want to really time it in that sense because there are lots of things happening around globally. So one, we're looking at interest rates going up, of course. That's not only an Indian phenomena, but also a US phenomena. World over, in fact, interest rates are going up. There is uncertainty and there is geopolitical tensions, which is continuously going on. And it is known that whenever there is an economic turmoil or some kind of, geopolitical issues in the market and equity markets being volatile, gold becomes a safe haven. That is what you also said when you began the show. So I don't think as a retail investor, you would really want to time your investing. I think if you have liquidity, most certainly go ahead and invest at 10% allocation basis into gold right now.
How does diversifying in gold in your portfolio really help you mitigate all the risk and also saves you from the volatility?
As you said, gold is a safe haven. Okay, so gold tends to do become a safe haven when all other investment options become volatile. So equity markets are very volatile. Volatile, in fact, I mean they are on a continuous downward trend. where markets have corrected significantly and investors are kind of wary of what the equity markets look for from here on as well. So gold overall will start becoming a safe haven and a place to park your money to preserve your capital. I mean, that essentially would be the element of investing into gold. So yes, allocations need to be done. There is no doubt on that part. It's a it's a market. It's a product which is not related, not correlated to the movement in the market. So the more volatile markets are going to be, the more the gold is going to become a safe haven for investors. So for retail investors, I don't think there is any need to particularly wait to invest if they have the liquidity. There is a sovereign gold bond issue currently open, which you can definitely park your money into.
Okay, let's talk about sovereign gold bond. What do you think of this investment option when it comes to gold investing?
So, well, if an investor has a clear agenda of investing into gold, okay, so we're not talking about self-consumption, we're not talking about using it for making jewelry, which is for self-consumption, any other purposes. If your objective is to purely invest in gold for a portfolio allocation point of view, then there's nothing better than a sovereign gold bond. For a couple of reasons. One, of course, we're looking at it being in a non-physical form. So, of course, all the concerns that an individual would have in terms of purity, etc., is taken care of. There are two significant advantages in sovereign gold bonds as compared to any other paper form of gold as well, which could be ETFs or gold funds. In addition to all the other benefits, there are two significant advantages of sovereign gold bonds. One, of course, it pays out an interest of 2.5% per annum. So every year on your investment, you're going to get 2.5% in addition to what actually the gains of gold has been going to be. Now, which over a period of 8 years becomes about 20% is the return that you get by investing in sovereign gold bonds, in addition to any other form of gold that you're going to invest into. The other major significant advantage of investing in the sovereign gold bonds is that on maturity, which is 8 years from now, all the gains that you have made is going to be tax exempt. So, which otherwise in any other form of gold holding is going to be a long-term capital gains, which is 20% with indexation benefit. So that's a huge advantage of investing in the sovereign gold bonds. Liquidity may be slightly restricted as compared to other forms of gold holding, but there is sufficient liquidity in sovereign gold bonds as well, more particularly after 5 years of holding the investment.
All right. So now we can see the issue that is open from today. It's going to be available for subscription till 24th June, and the price is 5,091 per gram. That's what RBI said. Now, one question to you is, Harsh. Now, these are the new issues which are being launched. One can subscribe in these issues, but what if one wants to subscribe to an older issue? Does it make sense? And if it does, how can you buy it?
Yes, in fact, as I said, liquidity is one part of investing into sovereign gold bonds.
Hmm.
So all those investors who have been
Hmm.
investing in the previous issues of this sovereign gold bond, and these bonds are
Hmm.
listed on stock exchanges. So like you buy shares through your broker on a stock exchange, the sovereign gold bonds are also listed on the exchanges. So in case you wish to buy, you have to simply go onto the exchange platform, and you can place an order to buy the sovereign gold bonds if and when they're available for sale by existing unit holders, existing holders of sovereign gold bonds. Uh, in most cases, you will also find that the sovereign gold bonds in the existing market, the pre-issued bonds and the existing investors wanting to sell, there's a great chance you will get it at a discount as well. So if the current issue is at 5,091, and even if you reduce the 50 rupees discount that you're getting for digital payments and application, it comes to 5,041. So there is a great possibility that if you're buying an existing issue bonds from the stock market, you may get it at even a cheaper price because somebody wants to exit, and the only way he can or she can exit is by selling it to a new investor. So you can quote a lower price, and yes, you can buy from the exchange through your stockbroker.
In the current scenario, after sovereign gold bonds, which is your second choice, gold ETF or gold bonds?
So well, gold ETF is again listed on the exchanges, and if any investor wants to invest, has to have mandatorily a demat account. So that is going to be a prerequisite if you're investing in gold ETFs. If you do not want to get into that rigmarole of demat accounts, buying through a broker, and then again, then you have, if you have to liquidate it, you have to go and sell it on the exchange itself. If you don't want to do that, then gold funds offered by the same mutual funds are again available, which is very easily liquidable. I mean, you can, it's simply based on NAV. You give it to the fund house back and they give you the NAV and the credit comes to you. You don't have to really search for a buyer yourself. So yeah, in terms of expenses, expense ratio, ETF will be cheaper, no doubt on that part, but it comes along with its set of things that you have to buy from the exchange, and it'll come to your demat account. Gold funds is far more simpler to use, easy for redemption and purchase, and you don't really need a demat account. So both choices are open depending on the preference of the investor.
All right, I think that's all for today, and thank you so much, Harsh, for explaining how gold can be a very good option when it comes to having an exposure in something that can be a hedge against inflation. Thank you so much, Harsh, for removing time and guiding our viewers.